If you're a beginner and you want to start investing, but you feel nervous or afraid of doing it wrong, you're definitely not alone. Most people hesitate because they worry about picking the wrong moment, especially here in Europe where the markets feel unpredictable. The good news is there's a simple way and beginner-friendly way to start investing safely, calmly, and without timing the market. In this video, I'll show you exactly how this method works using real numbers, 2 clear charts, and the monthly routine I follow myself. If you're looking for the best way to start investing as a beginner, even if you're nervous, this video will help you get started with confidence. I've spent more than 6 years researching investment and personal finance, and today I want to share a method that helped me stay consistent and calm. We've all been there. You finally save some money and think, okay, time to invest. Then you turn on the news. Markets at all-time highs, inflation, volatility, and you freeze. Maybe I should wait, you tell yourself. That little voice in your head starts whispering, what if I buy today and the whole market's tank tomorrow? Maybe I should wait. Dip everybody's talking about. That's the market timing trap. Trying to buy low and sell high sounds smart, but in reality it's almost impossible, even for professionals. Market goes up, FOMO kicks in, and you're tempted to pile in at the top. Markets go down, panic sets in, and you feel the urge to sell at the absolute worst time. This emotional roller coaster is exhausting, and worse, studies show that investors who try to time the market often end up with lower returns than those who just stay in the game. The secret to winning isn't being a psychic, it's having a system that works for you when you're feeling smart and especially when you're feeling scared. So what's the alternative? A calm, automatic approach called dollar cost averaging or DCA. The idea is simple. Invest a fixed amount of money at regular intervals, no matter what the market is doing, €100 a month, €50 a week, whatever fits your life. Some months prices are high, some months low, but you always keep going. You're not guessing when to buy, you're building steadily over time. Think of it as putting your retirement savings on autopilot. You set the amount, you set the schedule, and you let the system do the heavy lifting. This strategy flips the goal on its head. You are no longer a stressed out market timer, you're a calm, systematic accumulator. Your focus is on time in the market, not timing the market. And that's the most powerful principle for long-term success. Here's what it looks like. Each month I invest the same €100. When prices drop, that €100 buys more shares. When they rise, it buys fewer. Over time, all those monthly steps average out, shown here by the orange line, giving me a smoother, lower average cost. That's the power of consistency. You don't need to predict the market, you just need to keep showing up. To see why this matters, compare DCA with investing everything at once. The blue line shows a steady monthly investor, slower at first, but smoother through ups and downs. The orange line shows one big lump sum investment, more volatile, harder to stomach. In real life, staying calm and consistent often beats trying to be clever. The magic of dollar cost averaging really comes down to 3 superpowers. First, it puts your discipline on autopilot. The biggest enemies to your wealth are your own fear and greed. By automating your investments, you build a system that forces you to be consistent, taking your emotional brain out of the driver's seat. No more panic selling or FOMO buying. Second, it reduces the risk of terrible timing. Instead of making one big bet that could go horribly wrong, you're spreading out your risk over time. In choppy or declining markets, this is a huge advantage. Now, to be clear, if the market only goes straight up, investing in a lump sum at the beginning would lead to higher returns. But since no one can predict that, DCA is a powerful tool for managing risk in the real, unpredictable world. Third, it gives you your life back. Seriously, you don't need to be glued to financial news. You don't need to have an opinion on interest rates. You just choose your investments, set your schedule, and let the system do its job. It's passive investing at its finest, freeing you up to focus on what really matters. Understanding dollar cost average is one thing, but making it part of your real life is what changes everything. Step 1. Decide on your what and your when. Start by choosing how much you can comfortably invest on a regular basis. It doesn't need to be a large amount. Consistency matters more than size. Then you choose your schedule. Monthly is the simplest for most Europeans because it matches how our income usually comes in. Some people prefer weekly or bi-weekly, but monthly is perfectly fine. Step 2. Choose your where. Instead of 401ks or IRAs, we have simpler choices here in Europe. A standard investment account, a pension savings plan, or a lower cost ETF portfolio through a trusted broker. For most beginners in Europe, the easiest place to start is a basic brokerage account where you can buy broad low-cost ETFs. Many brokers make this easy, for example, platforms that allow small monthly investments or savings starting from €1. You can use whatever platforms you already have or feel comfortable with. The important part is the routine, not the platform. Just make sure fees are low and that your broker allows recurring investing or simple inexpensive monthly purchases. Step 3. Put it on autopilot. This is the step that makes the whole system work. Set up an automatic transfer from your main bank account to your investment account at the start of each month. Once the money arrives, automate your monthly ETF purchase or place it manually if automation isn't available. When you automate it, you remove the temptation to skip a month or wait for the perfect moment. It becomes a habit, calm, predictable, and sustainable. For this strategy to work, there is one thing you absolutely must avoid: to stop investing when the markets go down. I know how tempting it is. When your portfolio is suddenly full of red numbers, every instinct tells you to pause, to wait, to protect yourself. But with dollar cost averaging, a market drop isn't a danger, it's an opportunity. Think of it this way: when prices fall, the same fixed amount buys you more shares. It's the equivalent of high-quality investments going on discount. The people who keep investing during those uncomfortable periods are the ones who see the biggest benefit when markets eventually recover. Staying consistent, especially when it feels scary, is what separates steady long-term investors from everyone else. If this simple and calm approach to investing was helpful, feel free to like the video. It helps the channel grow and tells me you want more content like this. This routine helped me move from worrying about money to feeling in control of it. The secret to retiring wealthy isn't a stock pick from your weird uncle or a mythical ability to time the market. It's about discipline, patience, and consistency. Dollar cost averaging transforms investing from a high-stakes guessing game into a calm, automated process. It removes your own worst enemy, your emotions, from the equation and puts your wealth on a predictable path. It ensures you're always moving forward, one steady investment at a time. So forget the crystal ball, just set up your own plan, let it run, and go enjoy your life, knowing you have a silent partner working in the background to build your future wealth. Because true success comes from time in the market, not timing the market.